This is the Hacking Real Estate Podcast, Season 2, Episode 3.
I kind of jokingly say that there are three kinds of people in the world. There are those that make things happen, like real estate investors. There are people who make things happen, people who watch things happen. And then there are people who wonder what happened. And you don't want to be that latter category. So the important thing is to take action, because until you actually do pull the trigger and take action, you're not going to see your wealth go up. You're not going to see your income go up. You're not going to see things come out of it, the benefits that we want when we think about real estate investing or study real estate investing. So you definitely have to take action. Until you do that, nothing else matters.
Welcome to the Hacking Real Estate Podcast, where we dive into the stories of seasoned, hands-on, and tech-savvy real estate investors. We'll learn the strategies and tools they use to maximize returns and minimize hassle, all while navigating the rapidly changing real estate market. I'm your co-host, Brandon Hall, and managing partner of Hall CPA, and I'm sitting alongside my co-host, Vikas Gupta, CEO of Azebo. With our combined 15 years of experience in real estate investing and entrepreneurship, we're here to help you up your real estate game. Let's get hacking.
Hi, everyone. Welcome to this week's episode of the Hacking Real Estate Podcast. Our guest today is Marco Santarelli. Marco is a two-time Inc. 1000 entrepreneur, investor, author, Broadway producer, and the founder of Norada Capital Management and Norada Real Estate Investments, the largest nationwide provider of turnkey investment property. He's also the host of the top-rated podcast, Passive Real Estate Investing, with over 500 episodes to date. His mission is to help 1 million people create wealth and passive income and put them on the path to financial freedom. Marco, welcome to the show.
Hey guys, I'm pleased and honored to be here, and I'm excited for this episode. So thank you.
Thank you. So Marco, in your own words, can you tell us your real estate journey?
Yeah, my real estate journey in a nutshell is basically this. I just knew at a young age, in my early teens, I wanted to be financially free. I didn't want a job. I didn't want to have to work for someone else. So I took it upon myself to study two basic things. One is like business and entrepreneurship, and two was real estate investing, because I just knew from people that I was introduced to that you can be financially independent by owning a portfolio of real estate. And I wasn't sophisticated in any way at the time. I just had a hunger for learning and educating myself on how to become successful, especially in real estate. So when I turned 18, I set out to buy my first rental property. And I jokingly say I had to wait until I was 18 years old because I couldn't qualify for financing prior to that. But I was working a well-paying job at a grocery store. I saved up enough for a down payment. And then I ultimately just bought my first rental property, which was a townhome unit at an end of a complex, fixed it up, leased it. There was no internet back then. So, it was basically a newspaper and a sign on the front yard. But I leased it and managed it. And that was how I cut my teeth in real estate. And it was shortly after that I got my real estate license, started selling real estate, which I really didn't like, but I was only doing it for the experience and the commissions. So, I mean, truth be told, I'll be honest, it was just something I was hoping to make money at. But it gave me the access to the MLS to start buying another property. And that's really where I got started. And then if you just fast forward to the early 2000s, when credit was cheap, interest rates were really, relatively speaking, low, and it was easy to qualify for financing. I just hit the gas pedal. I just went full time in 2003, 2004. And over a 9-month period, I acquired 84 doors. And that was the one of the reasons why I started Norada Real Estate Investing, is because people were coming to me saying, hey, wow, how are you doing this? Can you coach me, mentor me, help me? And I said, no, I can't. I don't have the time, but I can help you with deal flow that I'm looking at. And that's how the business was started. So over the course of that time, I got involved in real estate and then really accelerated my investing and building my portfolio just over the years, especially with the help of cheap credit. So that's a long story short, if you will.
So a lot of folks bought a lot of property in 2003, 2004, 2005. A lot of those folks struggled a little bit in 2008, 2009. Like, how did you do and what did you learn going through sort of that tough times for real estate investing?
There was a lot learned, that we could talk about for literally hours. One of the biggest takeaways was this. A lot of people who thought they were real estate investors, and I say investors now in air quotes, were really speculators. They were buying real estate with the hope and anticipation that prices were going to continue to go up. And for a long period of time, they did. And they continued to go up until they didn't, right? And that's basically what happened. So, the tide went out, and you saw who was just standing there with their shorts down. So the problem is that a lot of people were buying real estate thinking they were real estate investors, but what they were really doing is they were really speculating on prices going up. So they were buying for appreciation or the anticipated appreciation in that property. And they were not paying attention to the cash flow of the property or the ability for that property to cash flow to carry itself, so that way you can service the debt. And that's why millions of people got into troubles, because when credit dried up, and the market dried up because there was an oversupply of housing and not enough demand to absorb that supply, people were left stuck with properties that they, one, couldn't sell or had a hard time selling, two, couldn't rent or lease, so they didn't get the income. And even when they did get the income from renting it out, they didn't have enough to cover the debt service, and so they were forced to basically let it go into foreclosure. And that's why there were millions of properties that went into foreclosure. And you look at some of the ground zero locations. It was like the Inland Empire of California, like the Riverside area, Las Vegas, Phoenix, and Southwest Florida. The whole Fort Myers, Cape Coral area, and that whole Southwest corridor, where there was just tons and tons of new construction going on. And the situation where you had cheap credit, easy credit, and the ability for people who could, jokingly fog a mirror and get, financing, it created a frenzy, and it just created all these speculators. So that was one of the biggest takeaways or lessons from the time is, look, if you're going to invest prudently, invest not specifically for cash flow, but just make sure the properties you're buying are in good markets, good neighborhoods, can carry themselves, meaning they're sustainable. They have the cash flow like the income to service the debt. So you do have positive cash flow, and have a medium to long-term time horizon or perspective on it. Because if you have a short-term mindset, short-term mentality about it, then you get into this trap of being a speculator, hoping and praying that you're going to have those unrealized gains in appreciation or equity. And you lose sight of the fact that it's a business and you need that property to carry itself. You need cash flow. Otherwise, it's not sustainable. It'll fail. So I guess that's a long way to say, don't be a speculator, invest for cash flow, and have a long-term horizon.
So you mentioned cash flow, you mentioned appreciation. I know you have a framework. What is it? The 5 pillars of wealth creation in real estate. Presumably those are 2 of the 5, or maybe I'm wrong, but why don't you walk us through how you think about it after your 20 plus years of experience?
Yeah, so I talk about, either the 4 profit centers or the 4 pillars of real estate investment real estate. You could argue there's 5, and I'll just go through them. But this is the way you can preserve and create wealth using real estate. So a lot of people, and when I say people, I'm talking real estate investors, are focused on sometimes cash flow, and that's great. They're building a portfolio and they want to create cash flow, either immediately over time. And other people are focused more on equity growth to create their net worth, increase their net worth. There's no right or wrong. You're going to get both. If you invest properly and wisely and prudently, you'll get both over time. But what's exciting about real estate, and why it's one of the most impressive and powerful asset classes to invest in, and actually you could argue it's the most historically proven asset class, is because it has these 4 or 5 pillars. And they're basically this. The first is essentially cash flow. When you invest in real estate, invest properly, you're going to have cash flow. And when I say cash flow, I'm making the assumption we're talking about positive cash flow, not negative cash flow. And you may not have that in the first year or 2 years for various reasons. It's a strategic play. You're actually planning it to be that way. But ultimately, you do want to have positive cash flow because you want the income, not necessarily because you need the income, at least not right away, but you want that positive cash flow for the income that your properties will kick off. But it provides sustainability. And when you have a down payment on a property and you look at that cash flow, it gives you an immediate rate of return. It's a realized gain, but it gives you a rate of return. It's either in the form of a cap rate or just your cash on cash return. That's the beautiful thing about real estate on the front end, short term. The second pillar, or profit center, if you will, is something that some investors don't think about too much, but most investors will finance their investment. And so they'll have a mortgage, whatever it is, 80%, 75% loan to value. And it's great. It's smart because you're using other people's money. But each and every year, in fact, literally every month, your tenant that is paying rent to you is effectively paying down that mortgage for you. And, it sounds like a very basic thing, and most real estate investors understand that. But what they don't understand is this, is that each and every month, that principal payment becomes larger and larger and larger. And as time goes on, you're paying off more and more of that debt, which means you have more and more equity in that property each and every month. So if you look at the equity gain each and every year, and you compare that, again, it's just a fraction, numerator and a denominator. If you divide that into your down payment, you make a rate of return. Now, I like to use a $200,000 property as an example. If you put 20% down on a $200,000 property, it's $40,000. If you look at the amortization at today's rate of 8%, that first year rate of return on the equity gain or the principal pay down, however you want to look at it, is 3.3% in year one. In year two, it goes to 3.6%. In year three, it goes to 3.9%, and then 4.2, and then 4.6 and 5. So you can see how this starts to increase. It's by itself a rate of return on that down payment you've placed, just in the form of the amortization of the loan, the equity gain. So that's the second profit center. That's the second pillar. The third is related to that, and it's just the price appreciation over time from appreciation. That is usually the whopper, where you get the highest rates of return. Let's just take, again, a very simple example. A nominal 5% rate of appreciation per year. It's realistic. It's not too high, not too low. In long term, over time, you're going to expect to see 4 to 7%. Let's call it 5. But that 5% rate of appreciation on a $200,000 property is $10,000 after the first year. It doesn't sound like a whole heck of a lot, but think about this. You put $40,000 down. That $10,000 gain, unrealized gain, but still a gain, against that $40,000 is a whopping 25% rate of return. That's pretty impressive. And then, if that happens again the next year, that 5% on that $210,000 property is now a 26% gain. And it starts to increase a little bit more each and every year. And it's very impressive, because now if you take that third profit center of appreciation, you add it to the equity gain from the amortization, another, 3.5%. You add that to the cash flow of that property. In my example, like a real example, it's about 6%, 6% rate of return from the cash flow. You're up to 34% in your first year as a total return on investment, realized and unrealized gains. That's pretty damn impressive. So those are your three profit centers. The fourth one is something Brandon can certainly talk about, forever, and that is the depreciation and the tax benefits of that depreciation, which is more money in your pocket because you're lowering the tax impact that would come into play from the cash flows of that property. So, those are savings in a sense, but those are immediate returns that go straight down to the bottom line. It's spendable cash. So those are four profit centers. And if you really want to throw in a fifth, I would call it leverage. The fact that you can actually borrow up to 80% of the purchase price, or sometimes more, and leverage your investment capital 5 to 1 is amazing. Like, you really can't do that with other asset classes. And so that's what makes real estate interesting, powerful, and attractive to virtually everybody, whether you're accredited or non-accredited. That's a long way to describe 5 profit centers of real estate, but really you got to stop and pause and think about what I just said, because when you start to add it up, we're talking about total annual rates of return that are in the 30% range and above, if you just do that simple math the way I did it.
If you own rental units but don't want to pay for expensive software, check out Azebo, the smarter way to manage your rental properties. With Azebo, you can automate rent collection, find quality renters, simplify accounting and tax prep, get a bank account designed for real estate investors, and save on rental property insurance. All of these services are free through Azebo. Join thousands of real estate investors who trust Azebo to manage their rental business in one convenient platform. Sign up today at azebo.com/HRE. That's AZIBO.com/HRE.
Thanks for explaining all of that. And what I like about the way that you just described everything is that even if one of the profit centers isn't necessarily performing very well, you still have 4 more, right? Which leads me to my question of the appreciation profit center. Now, the market has been pretty wild over the past couple of years. Where do you see the market going over the next 12 to 24 months? Like that appreciation piece, what do you think is going to happen there?
Well, on the one hand, this is a crystal ball question. You ask anybody this question, they're going to have, an opinion or maybe a prediction or a theory. So nobody knows definitively for sure. But, I spent a lot of time watching market information, housing trends and data and analysis on that data. So what we won't see is the wild appreciation we saw during COVID, like in 2020, 2021, which just was completely unsustainable. But we had just the perfect storm for that to happen. But what we do see going on for the rest of this decade is a lack of supply and still strong demand. Now that because of high mortgage rates having gone up to about 8% plus, which is, a record for a while now, we do see sales having slowed down even with new construction. But that's not sustainable. That will not continue for the next 2 years. We will see sooner than later the Fed kind of ease back and maybe not go back into a quantitative easing mode, but we will see them kind of stop pumping the brakes because there's going to be a breaking point in the economy where if they tighten too much, they're going to put the economy into a tailspin. They're trying to balance a lot of things right now, between employment, unemployment, cooling the economy down, cooling consumer demand down. But housing is a necessity. The thing is we have far more demand for housing and new housing units each and every year than we actually have supply. Even with the aggressive building that nationwide home builders have had recently over the last few years, they're not keeping up with the increased demand for new household units. Now, they have caught up. We're getting to a point of equilibrium, but that doesn't get us out of the deficit that we have for housing units. We need approximately 1.5, 1.6 million housing units per year. And for the longest time, we've been producing much less than that, closer to 1.1 million housing units. So we've been creating this deficit for many years. The only time we actually were in equilibrium was, believe it or not, right before the housing crash of 2007. It was really 2006, 2007 that we had meet or beat the demand side of the equation with the amount of supply being produced. But then, we kind of went into, a recession, which created all kinds of problems. So to answer your question, housing is still going to be a very viable, strong investment if you're talking about real estate as an investment. But even as a homeowner, the housing market, and I hate talking about the housing market as if there's this one national blob of housing. There's no such thing. All real estate is local. Everything happens at a very local and sometimes a hyper-local basis. But if you just want to generalize, housing is going to continue to be strong because of the simple supply and demand factors. It's economics 101. We have far more demand than we have supply. We're going to be this way until probably 2030. That's what I'm reading and seeing in terms of estimates before we get to a point of equilibrium. Am I bullish on real estate? Yes. Of course, you have to be very selective in the markets you choose and where you invest. Some markets are hot right now, some are not. And I'm talking about not in terms of price appreciation, but I'm talking about in terms of market conditions and demand. I guess all I can say about that is that I'm bullish on housing. I still see continued demand growing with supply lagging. And that's what's been pushing prices up to a large degree. That is also what has been pushing rents up aggressively over the last 3 to 4 years. All of that has cooled down now. Like the year over year rates have been coming down considerably. The next 2 years, we're probably going to see single digit and probably low digit growth in terms of rent, probably around the 4% in terms of rent. But the appreciation side of the equation is really going to be very much market specific at this point. So that's probably a long and complex answer to your question. You were probably hoping for a simple answer, right?
No, long and complex is good because it's not a simple problem, right? I'm curious, you talked about hating to talk about the housing market because it's so local and so hyper local. And you talked a little bit about like, one of the mistakes speculators made was not necessarily buying good properties in good neighborhoods. you just now talked about some markets are cooling off, some markets are still a little bit hotter than others. So that's a long-winded way of saying, like, what markets do you focus on, or what are you looking for in a market? Where are you active now, where you may not have been active a few years ago, and vice versa?
Well, those are two different questions. So what I look for is one thing, and what market conditions are right now is related but separate. To the first question, what I look for is pretty fundamental in nature. Markets that have jobs, a stable job market, but ideally job growth, is a market to be focused on. Now, that doesn't mean the numbers make sense, because you can look at, like the Bay Area, California Bay Area, there may be jobs and job growth, although there's a little bit of a pullback recently in the tech sector, but you may have strong job growth, but the numbers just don't make sense. Why would you spend over $1 million, for a small, one bedroom house that, doesn't rent for more than 0.3 or 0.4% of its purchase price on a monthly basis? The numbers just don't make sense. It'll be negative cash flow all day long. So jobs and job growth is one factor. And the other factor that plays in pretty strongly is population growth. Like, is there migration and population growth in that market? Because again, it's economics 101. If you have a growing population organically and through immigration, you're creating upward pressure on that housing market, which will not only sustain and support that market, but it'll also be a driving factor towards price increases because of the increased demand versus supply, as well as, upward pressure on rents in that market. So you being a landlord or a real estate investor, you want to see those dynamics in play. So jobs and job growth and population growth are two major factors that I look for in a market, and then tied to that, of course, is there a supply in that market? And also, do the numbers work? You don't want to be in a market like the Bay Area where it's impractical, but markets like Indianapolis, Kansas City, the greater Baltimore area, the Memphis, Tennessee, these are just examples of markets that we have inventory in, that we operate in, where the numbers actually do make sense. Kansas City, Missouri, Indianapolis, and places like that. These are markets that make sense numerically, and the fundamentals in the market are strong. So they certainly make sense. A little bit more, I say speculative in a cautious way, but a little bit more aggressive markets that have stronger appreciation potential because of the strong growth are the Florida markets. Not all of them. Like, certainly you wouldn't go into Miami or Naples. It's just too expensive. But, places like the Southwest Corridor, south of Tampa, all the way down to Fort Myers and Cape Coral, are experiencing tremendous growth. A lot of investor activity because of that growth. The numbers still make sense, although they're getting a little bit skinny on the cash on cash return side. But, these are markets that are experiencing strong to very strong growth, and we like those. So now I'm kind of transitioning into your second question, about like maybe where, and I'm not giving you financial advice or making strong recommendations, but certain markets like, Charleston in Atlanta, Indianapolis, Richmond, many of the Florida markets on the northern half of Florida are doing exceptionally well. They're just a great place to consider if you can get the right deal. Markets that are slow to very slow would include San Antonio and Austin. They've become overpriced and not favorable for investment purposes. Salt Lake City, to some degree, Vegas and Phoenix have had a very long and hot run. So it's also become a market that has slowed down and is not as favorable now as it used to be for investment purposes. So you just have to do your analysis, pick the markets, and for me, it's a top-down approach. I like to look at it like a funnel. You pick the best markets that make the most sense and have the right fundamentals. Then you work your way down to the submarkets and areas within that metro area. Then you focus on the neighborhoods that are going to have the highest desirability and where the numbers make sense. I always like to jokingly say, if you can find a $100,000 property that rents for $1,000 a month, a 1% rent to price ratio, which doesn't really exist anymore, that's ideal. That's an ideal scenario. Now you just have to have the right team, like the right property managers, et cetera, in place, and you'll do very, very well. But that $100,000 property is, hard to find today. Now it's the $150,000 property or more. So if you want to drill down on any of that, we can. I try and give you a big answer to your two questions.
It was a big question, so I appreciate the big answer. I mean, in today's environment with 8% rates, how has that shifted the way you think about, especially your first piece, your cash on cash return?
Well, higher mortgage rates certainly have affected the cash flows and the returns on at least the immediate returns, the cash on cash returns on real estate, because the cost of capital has gone up. It's much more expensive. And so that means your debt service is higher, and that means your cash flows are lower. So you either have to just deal with it and accept a lower rate of return, or lower cash flows, and then wait it out 2-3 years and then refinance to a lower rate. Assuming that we're going to see lower mortgage rates, which I anticipate we will. We'll probably see it drop down to the mid 5s within 2 years. That's certainly anticipated, and that's my prediction. But yeah, it's caused some people to pause and wait on the sidelines to see what happens with mortgage rates, to see if they're going to come down, or maybe wait until they do come down. So there are people who are waiting. Unfortunately, some people are waiting, thinking or hoping that we're going to see, a market crash or a rise in foreclosures. Those people will be sadly disappointed because we're just not going to see, what we saw in 2007, 2008. It's a completely different environment. The dynamics are different. We have true legitimate demand right now, and not enough supply. So those people who can't afford to buy real estate for their home or as rental property will do so. And the inventory, whatever inventory is out there, is what they're going to pick and choose from. But don't forget, there was a time decades ago, like in the 80s, where mortgage rates were 16, 17% or higher, and there were still people buying. The qualification criteria was different. It was harder to qualify. So that just means that you had to move out further to get a less expensive property to be able to afford it. Because for most people, it just starts with the monthly payment. What can I afford every month? And then you work it backwards. Okay, if I can afford this much, I can afford a home that's $100,000 or $200,000, and then you start looking at markets or maybe areas within your local market, however far away you have to drive from the central core to where you can afford it. You basically drive until you can afford it. So these are just the dynamics we're dealing with. But a lot of people will end up moving because they just can't afford the cost of living in places where they want to live. Be it coastal markets around the country, or Southern California, Northern California.
I've been hearing a lot about people who invest in some of those markets that you mentioned, like Florida, the Gulf Coast in general, concerns about rising insurance costs. Like, have you seen something similar, and how is that affecting the way you think about some of those markets?
Yeah, I haven't deep dived into it, but yes, I've heard and seen that insurance costs have gone up considerably in places like Florida. In some cases, even carriers have stopped issuing insurance, at least for the time being, which has made it more difficult to get insurance in some of these markets. But yes, it's an expense, in your investing. And if it's gone up, it's gone up. It's going to affect your cash flows and your rate of return. But I've also seen over the years that it is kind of a cyclical thing. Like, insurance carriers will jack up their rates, and they'll do that for a period of time, and then they'll readjust them, as the years go by. So they tend to come back down as, things kind of settle out, and they have control over their costs or whatever policies they're paying out on. It's nothing new. It's been around. It's just something you have to be aware of and anticipate, especially if you are in a state like Florida, or you've got property that's in a so-called flood zone or close to the coast. Just be aware that your insurance costs are going to be pricey, and they could potentially go up or be canceled, and you're going to have to go and find another policy. It just happens. But you just need to be aware of that, if not budget for it, but at least be aware of it going into the deal. Just, it's just a fact of life.
My understanding too is those insurance costs, like, it takes a couple years for insurance companies to rebase their underwriting. So like as insurance companies exit the markets, premiums go up because you've only got a few remaining companies in the markets. But my understanding, don't quote me on this, but my understanding is that those insurance companies will come back into the market a few years later once they kind of rebase everything. So I guess the point being that the drastic rise in insurance costs that a lot of people are experiencing on the coast might not continue. It might just be a temporary thing. I mean, I think that we're at a new high, a new premium price. Like, that's the new floor. But my understanding is that after like a 2-year period of this, you're kind of back to normal. It's just a new normal.
over the last 20 years since I, started investing aggressively and looking at Florida and then, launching Norada real estate investments, I've seen hurricanes come and go in Florida. And every time they come by, they create the damage that they create. Insurance companies are paying out on their policies. Some of them pull back, some of them, leave the market. And then they come back, a few years later, they just come back because they want the business. There is business there to be underwritten. And so they come back. Now they reprice, but, keep in mind, there's more than one insurance company. So it is a competitive environment. If you don't want to be the most expensive, because if you are, you're not going to get the lion's share of that market. You're not going to get as much business as you can. So fortunately, it's a competitive environment and people will shop, and they do shop insurance policies all the time. And so there's a tendency for it to normalize again over the course of 2-3 years.
You mentioned your investment firm. So you're providing turnkey investment property. Tell us a little bit more about that.
Yeah, so let's define what we mean by turnkey, because there's a lot of companies out there that have used that term, kicked it around, and to some degree plagiarized it. I started marketing the bejesus out of that term about 20 years ago when I started the business. And all the marketing and advertising and promotion that I did all wrapped around this concept of turnkey investment real estate. And for us, it's not only the properties, which are turnkey investment properties, investment grade rental properties, but it's also the experience and the process and everything that we bring to the table, from the education to the contacts and whatnot. That, to me, I call that a turnkey real estate investing experience. So you can be an investor investing in turnkey real estate and have both the service and the product as turnkey.
Real quick, I didn't realize that you were the guy that like originally kind of came up with that.
I didn't create the word. I just took that and I looked at the concept of turnkey investment, turnkey investing and turnkey real estate, and I just marketed the crap out of it. And I mean, if you type in turnkey real estate and any derivative of that on Google right now, we're always coming up number one, maybe number two.
I had the same experience with real estate CPA. So, for a long time, like I marketed myself as the real estate CPA. The domain name is therealestatecpa.com. And when I was doing it, there was one other firm that like said that they were a real estate CPA, but there's really nobody else saying it. I just realized people were searching for that term. And so I just marketed myself heavily. And so, yeah, we're kind of like same experience. Anywhere you search for a real estate CPA, we're going to show up number one. But now there's a lot of these real estate CPAs out there, or people saying real estate CPA. So it's interesting, but it's anyway, I know how hard that is. I guess my point is I know how hard that is to like make a term streamline. So hats off to you.
Yeah, and you too. And yeah, it's a very similar experience, what you just described, Brandon. Yours is easier to work with because people are very likely to type in real estate CPA if that's what they're looking for. But the term turnkey is not something that is common vernacular. People don't use that on a day-to-day basis. So it's not like someone's going to go to Google and specifically type in turnkey real estate, or at least not back then. Now more so because, it's more common to see it in publications, magazines, online, and wherever else. But yeah, which is one of the reasons why I had to market the crap out of it. But it is what it is. I wanted it to be turnkey real estate investments and turnkey real estate investing. And so those are the search phrases that I've, optimized for the last 20 years on an SEO basis and continue to do so. And that's why we basically own the space on search when it comes to that real estate investing.
And just real quick, because this isn't something we like have talked about on this show, but if you can come up with a term, like if you can look across other industries and you can come up with a term and you can apply it to your industry, and this goes for if you're a business owner, you're listening to this, W-2 job, investing in real estate, trying to build something, a business. If you can identify a term such as turnkey or real estate CPA and start using that term religiously, and then get other people to use the term, it's all going to flow back to you at the end of the day. Like, sure, you might have other people that take a little slice of your pie, but the whole pie's gotten a lot bigger because now everybody's looking for turnkey real estate investments, whereas they weren't before, right? People were looking for a real estate CPA in the past, but that keyword usage since I started this in 2016 has skyrocketed because now everybody wants to be called a real estate CPA. And so that's what they write about. And if we're the number one SEO, then we're going to get all of their views, right? So the point is that if you are a business owner and you're trying to build something cool, if you can identify a term that you can apply that nobody's really using and that you can apply to your business and use that on an ongoing basis, see some success, and then other people are going to see your success and say, well, I want to call myself the same thing or something very similar. They're going to start using that term too. As long as you can remain number 1 or 2 on those SEO listings, you will reap the benefits. Everybody else is going to do marketing for you, essentially. That's been my experience. I'd be curious to actually get your take on that. It sounds like you kind of had a similar experience because you're number 1 on the SEO on the Google listings for pretty much anywhere if you look up turnkey.
Yeah. Well, actually, it's actually pretty amazing how many phrases we dominate now, to the point where Forbes, like you name it, Wall Street Journal, everybody's quoting us now. They'll take content from our blog and then reference it, saying, according to Norada Real Estate, this and that. But that takes time. It takes years. Like, SEO is not a slow thing. It takes a lot of effort and a lot of quality content. And by quality content, it's got to be stuff that has value and people will want to read it or link back to it, like reference it. Because if they're not doing that, you're not getting the benefits of other people, giving you essentially a vote for, the content you have. So you do have to create a lot of content around those keyword phrases and derivatives of those keyword phrases. I'm actually surprised that nobody, was tapping into real estate CPA. It's kind of shocking because to me, it's so obvious. If you need a CPA that specializes in real estate, why not type in real estate CPA? But you even lock down the domain name, which again blows me away that someone else didn't take it.
Yeah, well, now there's a lot of now I do coaching with CPAs, and so there's a lot of firms out there that have kind of followed my methodology of calling themselves the CPA for something. Like, there's like the brewery CPA, the fitness CPA, I think there's even like the therapist CPA now and stuff, the dental CPA. So, but it works. It works. Like, if you pick a niche and you go all in, just like you did, you picked a niche, turnkey. It's all you're going to do, or it's what you're going to specialize in. It's a slower start, that's for sure. Like, if you're thinking about any sort of business and you want to niche down, I think that it's an amazing decision and a good strategic decision, because you can carve a moat that even copycats can't beat, right? We have a lot of copycat like accountants that do exactly what we do. They literally look at our engagement letter and they say the same price, same scope, and we're going to go and say the same things. So you're going to breed all these copycats. But if you are like the first mover, if you can niche hard enough and deep enough into that niche and market yourself well, you can create a moat that is untouchable. And that's the beauty of niching. But it is a little bit of a slower start, because you're saying no to 95% of everybody, right? You're only taking on a small amount of people. But man, once that engine gets going, once that flywheel starts spinning.
Yeah, no, I agree 100%. That's the experience I had. It was a slow start, but that's why I had to, push it hard for many, many years. But, that kind of leads to, your question about, what is turnkey real estate investing? For us, we had a specific definition. This is kind of where we went off on a tangent, which was great marketing tangent. But, it's like people are now kicking the phrase around, calling anything and everything, turnkey, almost like putting lipstick on a pig and saying, well, that's, a turnkey rental property. But that's not the case. At the end of the day, for us, what turnkey real estate investing or real estate investment means or is or should be is property that's in a good market, good to great market, in a good neighborhood. The property is in new condition, or it's either new or like new, so no deferred maintenance, and it's in good condition. There's nothing to be worrying about in terms of CapEx or maintenance and repairs. So good market, good areas, good neighborhoods, good property, professional full service property management wrapped around that, unless you opt to manage it yourself, but you should always have full service property management company or firm. That's basically the essence of it right there. And of course, should be cash flow positive with a qualified tenant in place. If you do that, you've mitigated 80% or more of your risk. And a big factor in that risk equation is actually the neighborhood, not the market. A lot of people get it backwards. So neighborhood, you can be in a shitty market and be in a great neighborhood, because there's always great neighborhoods in every single city and market out there. But if you're in the right neighborhood, you'll always have quality tenants, a good demographic, and you'll have desirability where people always want to live there, and you'll always get the best, like the cream of the crop living there. So that's how you mitigate risk.
So you're putting together these turnkey investments, and then are you selling it off to investors, or like, if I'm interested, sounds like too good to be true, but if I'm interested, how do I get involved?
It's funny you said too good to be true, because I didn't purposely say one thing before, which I will say now. Like all the value, the services we provide, the knowledge, the resources, and the properties, all that stuff comes at no cost or fee. So you as an investor, buyer, can work with us. We'll, figuratively speaking, hold your hand, walk you through the process, educate you, answer questions, find out what your goals or strategy is, talk about the markets you should be in, show you inventory, ready to go, turnkey investment grade rental properties in those markets, and help you go through the transaction, with escrow, with the financing. We have all the, connections to financing, the title companies, the inspectors that you need, et cetera, et cetera, et cetera. Like everything is through us. It's like, to use that phrase, it's been overused, but a one-stop shop. We provide you all that knowledge, resources, and contacts and properties at no cost. You have everything to gain and nothing to lose working with us. So yeah, it does sound too good to be true, but that's our model. That's what our model has been for going on 21 years now. January will make 21 years that we've, been providing that service. And as far as the markets go, we're in about 25 markets. About 9 or 10 of them are very active markets. I've mentioned some of them before, and it really just comes down to you as a real estate investor. Are you more focused on appreciation potential, or are you more focused on better cash flows right from the get-go, like higher cap rates? Or maybe you want a hybrid market. Well, that's fine. We have hybrid markets as well, where you get kind of less of each one, but a good balance between the two. I mean, that's what we do. I mean, that's what we love to do. That's what we've done for 20 years.
That sounds great. It's been a fantastic conversation so far. So if you don't mind, we'll go into our 3 closing questions.
Fire away.
So question number 1, what is your favorite book? And it doesn't have to be real estate related.
You're going to hate my answer. There are literally so many good books out there. It's really hard to pick one. I mean, is that even possible, right? I love so many different books for so many different reasons, depending on who you are, what you're looking for. On the real estate side, if someone's like doesn't have the right mindset, or they're just getting started, or they need that foundation, love them or hate them, I love Rich Dad Poor Dad as a foundational book. On wealth principles side of the equation, like Ray Dalio's book called Principles, which is this thick and it's like a door stopper, but it's a fantastic book. It talks about everything from life to investment philosophy. That's a great book to read. And it's one of those must-read books. If you're more conceptual and philosophical, stick to the tried and true books like Think and Grow Rich, or one of my favorites is How to Win Friends and Influence People. So I'll leave you with those 4, because those are 4, to me, must-read books.
Great. No, I love it. I love the best of category. I'm not hating you for that answer. I'm loving you for that answer. Second question, and we've touched on this a lot throughout this episode here, but if you had to pick one, what is most important to you in real estate investing, cash flow or appreciation?
Appreciation. I'll put a caveat on that, little asterisk. If I'm young, like Brandon, and I have time on my side, and cash flow is not important to me right now, definitely appreciation is where I would go, because I want to build my net worth as fast as possible. Because guess what? Later, in a few years down the road, I can tap into that equity growth and leverage it. I can compound my gains into more real estate, so I can fast track my wealth creation. If you're focused on cash flow too early and too fast, you're being myopic. You're focusing on something that's good, but it's not going to get you far fast.
Got it. Marco, I think you're the king of nuanced answers, which is good. It's a good thing.
I love nuance. Okay, good.
And our final question, is there any final piece of advice that you'd like to leave our audience with that we didn't get a chance to touch on?
You just opened up a can of worms, my friend. I'll tell you the first one that came to mind. The first one that came to mind is literally this, is take action. A lot of people will listen to your podcast. They'll listen to my podcast. They'll read books. They'll talk to people who are investing in real estate, but they either wait too long to pull the trigger and actually invest, or they don't do it at all. I kind of jokingly say that there are 3 kinds of people in the world. There are those that make things happen, like real estate investors. There are people who make things happen, people who watch things happen. And then there are people who wonder what happened. And you don't want to be that latter category. So the important thing is to take action, because until you actually do pull the trigger and take action, you're not going to see your wealth go up. You're not going to see your income go up. You're not going to see things come out of it, the benefits that we want when we think about real estate investing or study real estate investing. So you definitely have to take action. Until you do that, nothing else matters.
Great. Well, fantastic. This has been a great episode. Really appreciate you joining us. Before we let you go, though, where can our audience find you?
I'll just leave you two websites. There's my personal website, which is my name, marcosantarelli.com. And I have links to all of our ventures, businesses, productions, PE firm, everything is there. And then the real estate website is noradarealestate.com, Norada, noradarealestate.com. And tons of content and information on there, like tons. So you can't go wrong.
Great. Thank you very much, Marco.
I appreciate this, guys. Thank you so much.